President Trump has now reportedly asked his cabinet to draft a possible trade deal with China ahead of this month's G20 summit. We're now joined by Luigi Zingales, University of Chicago Booth School of Business professor, and Gene Frieda, Pimco's global strategist. So both of you, thank you so much for joining us on what is expected to be a heavy news flow on this Friday morning. Gene, first of all, are we expecting too much? If President Trump and President Xi have an agreement, they could always go back on it.
Yeah, I mean, I think, we all wish that Trump would spend a little more time on the phone than on Twitter, but it does seem to lead to more productive outcomes. Expectations around the U.S. China trade dispute are so low right now. I think that, any discussion is seen as positive because there hasn't been any talking up to this point. But I think, on the other hand, when you look at the nature of the dispute, it's very unlikely that we get a serious breakthrough anytime soon. Okay,
Luigi, what's your take? Will we get a breakthrough, and how much would it help the economy?
I am with Gene here. I don't think we're going to have a quick resolution because there are long-term problems between China and the United States, and I don't think they're going to be resolved with a phone call.
Luigi, we are looking at a trade war. I'm not sure if you've studied a trade war across the Zingales academics, but to find the immediacy and the urgency for our viewers in this phrase, a trade war.
So, fortunately, we don't study trade wars because they have not been so common. We're studying historically. Of course, there is the 1930s one that still looms very large. I think that the fear is more than an escalation in trade. I think that there is the realignment between China and the United States. Up to now, they've seen us more as partners. I think moving forward, they are going to see more as potential enemies or opponents. And I think this will change the global trade. And I think a lot of countries, and including Europe, have to decide on what side they are of this tension, whether they are on the U.S. side or the Chinese side.
Gene Frieda, what is so important here is the pricing within the markets, and we all look to fixed income for that. Are fixed income markets, after this odd market week, are they acting in a way you would consider to be rational?
I mean, I would say that they are acting in a way that is consistent with a world that's basically driven by U.S. growth. So a world that's dependent on the U.S. growth engine, an engine that still doesn't appear to be faltering in any material way. And the China trade dispute doesn't really seem to have gotten in the way of that. Obviously, we've had our first test of that with the equity market weakness, over the last several weeks. But I think we're still in an environment, if we look at the data, where, maybe growth is slowing a little bit and we're past the best, but it still looks pretty strong. So I think it's pretty consistent at this stage.
Gene, 2 days ago, we were talking about a possible correction and the end of the bull market. It has been the most unloved bull market. Now we talk about equities rallying, risk-off mood, or risk-on mood, actually, because we see the U.S. China. How quickly can things turn again?
I think they can turn quite quickly. I mean, and that's the tricky part right now about how do you invest. If you look at what's priced into certain equity markets, like emerging markets or even European equity markets, it's almost like we're priced for some kind of recession. That's not the case in the U.S. The U.S. in that respect seems to have a lot more potential downside. But, I would say that things can turn on a dime, particularly as if you look at the strength of growth, it really is concentrated in one place. Everywhere else looks pretty weak and weakening.